In this presentation, we will continue on with our corporation comprehensive problem entering the adjusting journal entry for insurance. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Note that we are moving to the adjusting process now, so we've completed the process of entering normal business transactions into the general journal, posting them to the general ledger. We're now moving to the tab where we're going to do the adjusting journal entries, and that means that we're moving to a worksheet where we're going to take things kind of out of the normal system and move them into kind of a worksheet basis, and that gives us a quicker look at what will happen with these adjusting journal entries so that we can see exactly what the effect is on each individual account and on the accounting equation. So we're now looking at a tab that looks like this. We've got our accounts, we've got the unadjusted trial balance, which is the end result of the transactions that we have done for the month. And then we're going to make these adjustments, which are kind of like special adjustments we're going to make as of the end of the month that we just plan on doing as part of the system to make ourselves more on an accrual system, and that will give us our adjusted trial balance. So remember, as we look through these, we're looking at these are kind of special adjustments, and they're going to be a little bit different than the normal kind of transactions. If we know the distinctions and the differences of them, they'll be easier to do. So if we can name something, this is an adjusting journal entry as opposed to a normal journal entry, then we can know the characteristics of an adjusting journal entry and make it a little bit easier to do them and build them. So an adjusting journal entry is not a journal entry that's going to be fixing errors per se. We may fix errors in the adjusting process as we go through it, but an adjusting journal entry is really part of the system. We plan on doing it. In other words, if we did the accounting process perfectly, we would still have adjusting journal entries because that's part of the plan. And the adjusting journal entries are going to be entries that don't deal with cash. So unlike normal journal entries, when we always ask the question, is cash affected? We don't ask that question here because cash will not be affected, because that's the nature of the adjusting journal entries. We're always going to make them as of the end of the month or the end of the time period, whenever the date of the financial statements will be. And they're always going to have, typically, they're always going to have one balance sheet account, or more specifically, an asset or liability account, something between these two areas, in one income statement account, which is going to be something down here, revenue or expenses. And if that is the case, we know that these accounts, revenue and expenses, only go up. So in other words, revenue only goes up in the credit direction, expenses only go up in the debit direction. So if we know that, we can put together these accounts, these journal entries, even if we don't know exactly what we're doing. So what we're going to do as we go through these adjusting journal entries is go through a process of just thinking about adjusting journal entries, build as much as we can by just going through the thought process of what an adjusting journal entry is, and then go back and think about why we're doing it and what's the point of all this. So first we're going to say, okay, this is an insurance expense journal entry related to insurance. So if we look at our trial balance, we say, okay, there's going to be two accounts basically related to insurance that we're going to have to deal with. One's going to be in the assets or liabilities or balance sheet account. And so if we look through here, how about insurance, prepaid insurance? And usually it's that obvious. It says prepaid insurance. That's the one we're going to be dealing with. And then one's going to be on the income statement account, revenue or expenses. And if we look through those accounts, we see insurance expense. And again, it's usually that obvious. So obviously it's an adjusting journal entry. We're going to deal with related to insurance. So we're going to pick the two accounts that are dealing with insurance. Now the expense account down here is an expense account. Like all expense accounts, it has a debit balance. Like all expense accounts, it only really goes up. We pay the insurance company, they don't pay us. So that means that we're going to make it go up. So I know that. So how do we make it go up? We're going to do the same thing to it, which is another debit. So we know that we're going to debit insurance expense. And that means that we must be crediting the other side, which is going to be prepaid insurance. So notice we can basically get all that just basically from knowing that we have an adjusting journal entry that deals with insurance, even if we don't know anything else. Now to get the dollar amount, so if we were to post this out, we're going to have to debit insurance expense and credit prepaid insurance. So we know this part just from the fact that we're dealing with an adjusting journal entry and its insurance. Now the dollar amount we have to do a little bit more work on. We're going to say, okay, well, where did we get this $1,000? Well, we put the insurance on the books for $12,000 here. That's what we bought it for. And all of these adjusting journal entries as well, you got to kind of know the story. We actually put the books on there. We know where this $12,000 came from because we recorded it. But anytime you do a book problem, if it's an adjusting journal entry, they're just going to tell you, well, the prepaid insurance was $12,000, or we paid this much for insurance. And then they're going to try to tell you how much has been expired. So in this case, we're going to assume that one entire month was expired, and this insurance account was for 12 months. So if that's the case, then we would say, okay, we would take, and I know we didn't actually buy this on January 1st, but that's going to be the assumption just so we can see how this would work. So we're going to say, okay, this insurance was for 12 months. So if we would put that into our system here, we're going to say 12,000, and we're just going to divide that by 12 months. So we're going to say 1 month, then it would have expired is 1,000. So we're going to say that 1 month has expired, it's 1,000. Now sometimes a problem will give you that, and note that they can give it to you in two different ways. They could say, well, this is how much has been expired. We can say that 1 month has expired, or $1,000 worth of insurance coverage has expired. Or they could say that how much is left, or in other words, prepaid insurance should still be 11,000. And if they say that, we'd have to do a subtraction problem. If they say, well, prepaid insurance should still be 11,000, well, that means that if we subtract the two, we'd have to reduce it. 12,000 minus 11,000, we'd have to reduce prepaid insurance by 1,000 to bring it down. So here's going to be our transaction. If we post this, let's see if it does what we think it should. Now again, we're going to do this in a little worksheet so we can really see what happens. What do we think it should do? We think that the insurance should go up by 1,000, bringing net income down. We think that the prepaid insurance should go down by 1,000, leaving 11 months left, or 1,000 times 11, 11,000. So here's the insurance. We're going to say it's going to go from 0 up in the debit direction to 1,000. And then we're going to post the prepaid insurance. Here's prepaid insurance in our worksheet format. It's going to go down by 1,000 to 11,000, which makes sense because 1,000 times 11 months would be 11,000 left that we're going to depreciate over the next 11 months because it's a year's policy. So if we bring over all of the accounts, then here's what our worksheet should look like. We're going to say, here's our beginning numbers. Here's what changed, the prepaid insurance and the insurance expense. Everything else is just pulling over. So we're just saying this column plus this column is this column. This column plus this column is this column. All the way down. But the only thing that changed here, of course, is prepaid insurance. This is a debit balance account minus the credit brings us down. Now note how much easier it is to use this worksheet with debits being positive and credits being negative. In other words, credits being represented with brackets and debits without brackets. If we did not do that, and you'll see this oftentimes with some worksheets, then this thing would be 6 columns long because you would need a debit and credit column here, a debit and credit column here, a debit and credit column here. And the formulas would be a lot more confusing. It would just be a lot more confusing to look at. So also, if you think about it from software like Excel, the formulas here are much more simplified, meaning the formula here is just a summing up of these two numbers, rather than me having to say this column minus this column plus this column minus this column. You don't need to do that. It's just very simplified to look at and simplified to calculate both by hand and in a system. So I highly recommend when using a worksheet like this type of format. So again, we're just pulling these numbers over. This column plus this column plus this column, no change, no change, no change, until we get down here, 0, and then we're increasing it in the debit direction to a debit balance of 1,000. So that's going to be our end number. What happened when we did this? Well, the prepaid insurance goes down, the asset went down, and then insurance expense, the expense went up. So the expense went up, that brings net income down. So net income went from 19,006, which is 27,000 revenue, minus the wages, utilities, and telephone. And then we increased the expense for insurance which brings that net income down. Remember, the brackets don't mean it's a loss. It means that the credits are winning on the income statement. And that's because credits are good kind of on the income statement. Whereas on the balance sheet, we tend to like the debits because assets are debit, liabilities are credits. On the income statement, credits are revenue, debits are expenses. That also, of course, brought total equity down because revenue, net income went down, and that's going to bring equity down in the same direction. For more accounting information and accounting courses, visit our website at accountinginstruction.info.